Welcome to this lecture on how exchange rates act as the engine of trade and investment. In the next few minutes, we'll explore the channels through which currency moves reshape export competitiveness, capital flows, corporate margins, and policy choices, and we'll highlight practical tools firms and policymakers use to manage risk and sustain economic stability. This slide contrasts floating and pegged exchange rate regimes and why the choice matters. A floating system lets the currency move with market forces, absorbing shocks and giving policymakers flexibility, while a pegged regime delivers stability by anchoring to another currency or basket, but limits shock absorption and constrains policy options. So the trade-off is between flexibility and rigidity. Here we look at how currency valuation influences export competitiveness. When a home currency weakens, domestic goods become cheaper abroad, boosting export demand and helping firms capture market share. Conversely, a stronger currency raises foreign currency prices of exports and can reduce overseas demand, so currency moves translate directly into cross-border price competitiveness and sales outcomes. Currency depreciation raises costs in ways that differ for firms and consumers. For firms, cheaper currency means imported inputs become more expensive, squeezing margins unless prices or productivity adjust. For consumers, imported goods and services cost more, eroding real purchasing power and dampening domestic consumption, so depreciation often transfers pressure across production and household budgets. Exchange rate shifts alter relative prices, which then change export and import volumes, depending on how price-sensitive those flows are. If a currency is undervalued, it typically boosts net exports. If it is overvalued, it shrinks them. The net effect on the trade balance depends on how responsive volumes are to price changes and the timing of those adjustments. When investing abroad, total return in domestic currency combines foreign asset performance and the percentage change in the exchange rate. Positive currency moves can magnify profits, while adverse moves can erode them. So two investors with identical foreign asset returns can experience very different domestic returns purely because of exchange rate fluctuations. Volatility in exchange rates squeezes corporate margins through two main scenarios. A strong domestic currency can shrink converted overseas revenues for exporters, while a weak currency raises input costs for importers. Either way, unexpected currency swings can erode profitability unless firms adjust pricing, sourcing, or hedge exposures to stabilize margins. Expectations about future currency moves shape capital flows today. If investors expect appreciation, foreign capital floods in chasing yield and currency gains, lifting asset prices. If depreciation is anticipated, capital flees, tightening domestic financing and pressuring markets. These expectation-driven flows can amplify real effects on funding costs and investment decisions. Central bank policy rates are a powerful lever influencing exchange rates. Higher policy rates tend to attract foreign capital seeking yield, supporting the currency and strengthening asset prices, whereas lower rates can reduce inflows, weaken the currency, and make exports more competitive. So rate policy interacts directly with currency demand and broader economic goals. Hedging FX exposure turns uncertain future currency moves into more predictable outcomes using forwards, currency swaps, and options. Forward contracts lock rates for future settlement, swaps exchange principal and interest flows over time, and options provide the right but not the obligation to transact, all helping firms protect margins and stabilize cash flows. The transmission mechanism links exchange rates with trade and capital channels. Exchange rate changes affect terms of trade and conversion factors, interacting with real shocks that alter production and consumption, and financial shocks that move asset prices and interest rates. So currency shifts often sit at the center of broader macroeconomic adjustments. To respond strategically to exchange rate dynamics, monitor key drivers like interest differentials and market sentiment, deploy hedging instruments to mitigate volatility, and adapt pricing, sourcing, and cost structures to maintain margins. Combining proactive tracking, financial hedging, and operational adjustments helps firms and policymakers manage risk and preserve competitiveness as currencies fluctuate.